In this Patreon requested video, we're going to go through the steps of constructing a dividend portfolio and look at some specific investments for someone who's already reached retirement and is looking for maximum income. So this would imply that you're no longer working and you're not interested in any kind of dividend growth like SCHD or realty income. Basically, the money that you have to invest is all of the money that you've accumulated throughout your working career, with the exception of Social Security and any other investments that you're just not interested in putting into dividend stocks. You only want the higher yielding investments that are reasonably safe and are going to pay you as much as possible with what you've earned in your career. So in constructing a retirement portfolio that's focused on income generation, there are a few considerations that I would keep in mind. There are certain investments that I would prioritize over others, which would be the investments that offer higher yields. So some of those would include closed-end funds, business development companies, covered call funds, master limited partnerships, and preferred stocks. I would not prioritize equity REITs, mortgage REITs, dividend growth funds, and individual lower-yielding dividend stocks like Procter & Gamble. Now, if you've held an individual stock for a very long time, like let's say you've been a shareholder of Coca-Cola for 20 years, then you're going to want to check your yield on cost. Your yield on cost shows the dividend yield associated with the initial price paid for an investment. Let's say you bought shares of Coca-Cola back in 2002 when it was offering a 3% yield and paying 10 cents per share in dividends. Today their stock now pays 51 cents per share in dividends and it yields 2.89%. The shares you bought in 2002, though, aren't yielding 2.89%. That's how much yield you would get today if you bought their stock. The shares that you bought back in 2002 now pay 5 times as many dividends, meaning that those shares are now yielding over 15%. The reason that I say this is because sometimes people will ask me if they should sell some of their individual stocks that they've held for decades for some higher yielding assets like closed-end funds. In my example, your individual stocks are yielding over 15% because the dividend has 5x'd. You're not likely to find an investment yielding 15% that's as safe as Coca-Cola. So my advice in those situations would be to hold on to those shares. Going back to our considerations, I would also prioritize diversification, and this is what I generally like to do. If we're looking at an individual company, like a business development company or a master limited partnership, I would try to limit each stock to being no more than 5% of my portfolio. In this stage of life, dividend cuts are much more devastating. If we're looking at ETFs and other diversified funds, my advice would be not to make any of those more than 10% of your overall portfolio. If all of your holdings make up 5%, that's 20 positions. If everything makes up 10%, then that's 10 holdings. Generally, I would say ETFs are safer than closed-end funds because it can be harder to predict dividend cuts with closed-end funds, and depending on the closed-end fund, they can also hold riskier investments like junk bonds. Keep speculative holdings down to less than 2% of your overall portfolio. If you want to try your luck with some of those crazy high-yielding investments like what YieldMax is offering, then make it a very small amount of your portfolio. Finally, if you've set your brokerage account to not reinvest your dividends and you're receiving them in a money market fund or someplace they go before being transferred to your bank, then still try to reinvest the funds that you aren't using. Make it work for you and buy more holdings in your account. Now, with all that being said, what are some holdings to consider for a retirement income portfolio? We'll start with an asset class that has a good reason for not being considered by most, but I still think they're really good holdings, which are master limited partnerships. These are one of the only types of investments that exist that can offer both a high yield between 7 and 10% on average and offer distribution growth. There are 2 caveats to MLPs that you have to keep in mind. First, they come with an extra tax form called a K-1. Every other dividend investment issues a 1099, but MLPs issue a K-1. And if you use tax filing software like TurboTax, they always charge more. If you go to a place like Liberty Tax or H&R Block, then they will charge you extra to manage it. So unfortunately, these do require a much larger investment for it to be worth it. However, MLP ETFs issue 1099s, not K1s, and those can be held in a retirement account just like any other holding. So what are some good master limited partnership holdings to consider? There's a few good picks in this category. My favorite MLP continues to be MPLX, which currently yields around 8%, and you can see their distribution track record has been excellent. As of their most recent quarter, their distribution was more than 150% covered. But another alternative that's also really good is Enterprise Product Partners, ticker EPD. They're a much older company that has a great history of growing their distributions as well. Alternatively, if you want to avoid a K1, then the best MLP ETF, in my opinion, is the Alerian MLP ETF. This one issues a 1099 and is well diversified, making it a safer investment because of that extra diversification. Moving on, another great group of investments are closed-end funds. These are similar to mutual funds and ETFs, but they come with a few differences. All three are diversified investment products that hold a collection of different investment types, but CEFs will sometimes also hold investments that you typically don't see in an ETF or a typical mutual fund. So that could include common stocks and preferred stocks, but it could also include junk bonds, collateralized loan obligations, convertible bonds, and so forth. What sets CEFs apart from most is that they almost all use leverage to a certain degree. They do this to offer significantly higher dividend yields, which most CEFs also pay monthly distributions. Almost all are actively managed as well, and they come with a higher expense ratio. So those are the pros and cons of holding these types of investments, but many have great track records of perfect dividend histories, and again, they pay high monthly distributions. There's a lot of different CEF types that exist. You have your bond funds, real estate funds, and so on. There's a handful that I would recommend for people who are looking for some high monthly income. Ticker UTG is a fund that holds utility companies, and it has a perfect dividend track record. I hold this fund, and I've been really enjoying the returns up to this point. Another good CEF is UTF, which is a fund that holds companies that are infrastructure heavy. These two investments currently yield around 8% as of the making of this video, and they both pay monthly distributions. PIMCO has several CEFs that hold a wide array of assets including bonds, mortgages, and international holdings. PTY, the PIMCO Corporate and Income Opportunity Fund, has been a really solid performer up to this point. It does hold riskier investments, but it's had a solid track record and it yields over 10%. Another good investment type to consider are preferred stocks. Preferred stocks are a type of equity that has characteristics of both stocks and bonds, which makes them a hybrid kind of investment. They have payouts that are similar to bonds with regular cash distributions and fixed payment terms. Many different types of companies will issue preferred stocks, including REITs, banks, utilities, and some tech companies as a way of raising additional capital. Preferred shareholders have priority over common stock shareholders for payouts in a liquidation as well as receiving regular dividends. So sometimes we'll see a company cut their dividend on their common stock but not their preferreds because of that higher priority. The downside is that, depending on the type of preferred stock, there's usually no potential for dividend or share price increases. So they really are like bonds, but they can yield between 7 and 10%. Annaly Capital is a company that issues preferred shares of their stock that are much safer in my opinion than their common shares. But just like with MLPs, there's also ETFs that hold them. I like ticker PFFA, which adds some leverage to boost its dividend yield. That makes it a little riskier, but it's adding risk to a safer investment type, so I view it as kind of a trade-off. If you're going to go with individual preferreds, I would go with the preferred shares of larger companies. Avoid investing in preferred stocks that are issued by very small mortgage REITs, because even those have gone through dividend cuts. I would also follow a pretty similar strategy with business development companies. A BDC ETF to consider would be PBDC. This one offers diversification across a lot of these stocks, and I personally like it more than another ETF, BIZD. I've always said that when it comes to these types of companies, there's always strength in numbers, so I would stick to the larger BDCs if you do want to play it safe. That would include companies like Ares Capital, the largest BDC in the sector. When it comes to covered call funds, I included these because technically some do provide growth with a lower yield. But there's now a very wide array of CC funds that exist, and a lot of them use different strategies. SPY is a fund that's done really well even in our crazy stock market environment. At one point, the S&P 500 was down 19% for the year, which is what SPYI uses its strategy on. But despite that hard fall, SPY has been able to recover really well, and from a share price perspective, it's almost in the green for the year, just like the S&P. If you want more risk, then QQQI is NEOS's NASDAQ fund. It offers an even higher yield than SPY, but a lot more volatility. Both ETFs also offer more predictable distributions, unlike JEPI and JEPQ, which are still good funds, but again their dividends are much more volatile. So that's going to be our look at how to build a retirement income portfolio, as well as some suggestions in terms of what you should consider. Let me know your thoughts in the comments and what investments you like to recommend for retirement. But with that being said, that'll conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.